pullback. Put up the heat map up here, quite a sea of red on the equity side.
And for sure, equities and energies, yeah. So
yeah, so Michael lead us through the energies, I'm sure, and some of the metals, but let's just review the news flow this morning before we turn it over to Mike. So if I miss anything, also Mike, just interrupt and let me know.
Sure thing.
Okay, so overseas, the only real news was that Lufthansa, which is Germany's biggest airline, considers 26,000 of its employees as surplus. So they're probably going to downsize a little bit, I would think. Moving on to the U.S. In the statement, the Fed replaced commentary around the future QE plan from doing QE quote in the amounts needed to promising to do. I think what the market is reacting to more, though, now that they're thinking about it, is he my assumption is that there will be a significant chunk, well into the millions of people, who don't get to go back to their old jobs, and there may not be a job in that industry. At the beginning of this year. So, right. I mean, kind of a round trip there. Put more directly, I think Powell said the economy is a disaster and we don't see any signs of an imminent rebound, but the Fed is around to do whatever it takes to support the economy until it gets better. So the Fed put is still there, although it's not working so well today. From a sector standpoint, I think what he said undermines, and I talked about this yesterday. I said the movement yesterday into the super mega cap stocks, which we saw Thursday, initial claims. Price index also came out. increased 0.4%, but the core, excluding food and energy, actually dropped 0.1%. Key takeaway here is there is no inflation in the short term, which will not obviously keep will keep the Fed from raising rates, not that they were going to anyway. So the market narrative seems to be that the things that we were yesterday, or the day before, I should say, just saying, yeah, the economic, we have growth worries in the economy, not bothering us. We've been having a pickup in corona cases, not bothering us.
Right. Mm-hmm.
So it's just showing you that now they're worried about it, and they weren't worried about it before. The other thing I noticed is that Treasury Secretary Mnuchin came on CNBC a little while ago and said that no matter what happens with the COVID-19, shutting down the economy a second time isn't going to happen. He also said that he's prepared to go back to Congress to try to get more fiscal spending if needed. I don't know. Did I miss anything, Mike?
No, I think you pretty much covered it. And it's really kind of interesting how the market is kind of how quickly the sentiment had turned. And I think the timing of the Fed meeting and the commentary from Chairman Powell there was precisely at a market that has probably maybe gotten a little bit overextended, at least in the short term. So this market was probably due for a little bit of a correction, and that seems to be the catalyst there, that tied to some of the spikes in some of the COVID cases in certain states that have started to reopen as well too. So it's almost like a perfect storm there for the market, a reason for a bit of a correction, and we got it in spades today. And we're seeing a lot of that also in some of the commodity markets today too, Lee. So let's start out with the crude oil market, since that's also one that's heavily in the red on our heat map there. Let's look at August crude, CLQ20. Look at some of the summer months here. And this market has started to pull back. We had a little bit of a test a couple days ago. I think it was on Monday, actually. We finally got above $40 for the first time since the market formed that gap there back in March, and met a little bit of a selling, as you would think when you hit kind of a key milestone like that. But today it took out a couple of indicators we're watching. One of them was the 10-day moving average. That's the indicator there in white, but it also took out the uptrend line if we drew that from the April lows as well too. Right now we are currently testing the 20-day moving average. That's the indicator there in orange, right just above that $35 zone. So I would say we're probably at maybe a little bit of a near-term support level here for the oil market, just because of the 20-day moving average there. Chart-wise though, I mean, if you want to take away these moving averages and all that, chart-wise though, you probably don't see any kind of significant support here until probably about 31.25 to 31.30. It's around the May 22 lows there as well too. So if the 20-day moving average can hold this market support a little bit there, we may have another $3 or $4 on the downside. On the upside, we still haven't fill in that chart gap that comes in at 42.17. That was the March 6 lows. That is your upside target, assuming the market can close above 40. And if the closes up the gap and still's got some way to run, then we were looking at the 200-day moving average there above 45. But this market was a little bit overbought. With RSI got above 70. We're starting to pull back here. Still haven't got back to 50. So if I was watching the crude oil market, I'd want to watch the 20-day moving average, as well as if we keep going for on the way down, check that the RSI. If it starts to pause around that 50 zone and starts to turn up, then maybe we've seen the end of this bit of a correction. But chart-wise, though, we can go down as low as, like I said, 31.30 to 31.25 for chart support.
Uh, we, we,
Yeah,
yeah, we got a question on
Sure.
yesterday's EIA report.
Sure.
What was it?
EIA crude oil up 5.7 million barrels. Trade was looking for a decline of 1.2 million, so that was definitely bearish. We also saw builds in both RBOB and heating oil. Anything supportive there was that, once again, Cushing, Oklahoma storage, it was down another 2.3 million barrels. So they're taking out that storage concern, but overall, in fact, I think crude oil inventories now in the U.S. are at the highest levels ever for this time of year. So that was definitely a little bit of a pause there in the market, but it didn't do it yesterday. It did it today. So that kind of follow through. But yeah, overall, the tone was kind of bearish.
All right.
Let's look at gold, August gold next. Now, if you remember last week, I was getting a little concerned about the gold market as given the weakness in the dollar, really wasn't rallying as much, and we had that pullback for a few days where we actually kind of tested some of those support levels that we took out the near-term support and kind of fell below. As you see, we have that trend line drawn there as well too. But the market, once again, every time we have this sell-offs, it seems in gold, Lee, that we find buyers in the market, and the market has rebounded the last several sessions here. To me, though, I think this market looks really range bound within about $120 ranges. On the downside, 1670 to maybe 1665 is your support zone. And on the upside, we got to look at that double top, which comes in around that 1787 to 1789 zone. So right now we're pretty much almost smack dab in the middle of that zone. So I think we're going to see a lot of choppy trade in gold. And right now, I think it's kind of a sideways market, a trading market. I think you got to go with the momentum here. If we could take out those lows around 1660, then maybe the upward trend may be in a really in a bit of jeopardy, and we could maybe see a test down to even 1600, right around that 200-day moving average. To really get me bullish, though, I'd want to see a close above that double top high. Particularly, I want to see a close above 1800. So I think we're in a consolidation here for gold, two-sided trade, and I would just really initiate a trade really on any kind of breakout of the $120 range we're in for gold. Let's look at copper as well too, because that's another interesting market that I think is kind of fitting the tone what we're seeing in the equity markets today. HGN 20.
Yeah, it had been supporting the rally, and now.
I mean, look, we hit that 270 zone. I mean, this market had a breakout above the 200-day moving average. I mean, everything was going well for the bulls in the market until today happened, and it's really mimicking what we're seeing in the equity markets. It's kind of had a little bit of a reversal here in copper. So right now we got that 200-day moving average that we're testing here. So that's definitely a key area I'd be watching as well. If that doesn't hold, we have the 10-day below that, but I think you got to look at that 250 zone as a potential near-term target if this market continues to see a little more profit-taking selling or long liquidation here. So that's a key area that I would want to see contained. If 250 can't hold, I mean, we got a lot of that sideways action all the way down to 240 and then just below that as well too. But I think 250 may get a little bit of pause in the market. I think it's going to take a little effort now to get above 270, and above 270 we have, if you go way back there, back to late 2019 to 20 when we're back there as well too, there's a lot of sideways action between 270 and 280, so you have some decent overhead resistance there in the market. Fortunately, the large specs aren't heavily long copper yet, so that may actually kind of be a good thing. If you're long copper here, that's a good thing because you won't maybe see as much selling pressure if we take out some of those key levels like the 200-day moving average. So I'd be looking to see how the market reacts at 200-day moving average, at that 250 zone if that can't hold. And I would say if you're still long the market, maybe tighten up your stops or maybe place them just below 250, because I think that's where you may run into a little bit of problem should the market take out that area. So Lee, let's turn it back to you.
We're ready. I've had several questions. The difference between the just general Treasury bond future and the Ultra T bond future. If you could just explain that.
It's really just the time frame of the bonds to maturity there. Traditionally, you would think of the Treasury bond futures as being the long dated bonds, but in general, the time frame that's deliverable there is usually in that between like, was it like 15 to 22, 23 years, whereas the ultra bond now is the far end of the curve from like, I think 26, 27 years out to 30 years as well. So it's just really just a little bit longer duration on the ultra bond. And because it's longer duration, you'll see much more volatility in the price moves as well, because it'll move a lot bigger change in the yield based on the price move at these levels. So it's really just a longer term of the longer term bonds.
All righty. Thank you for that. All right. Speaking of interest rates, our nice rally in the 10-year yield has stopped. The comments on the economy were obviously not good for rising rates, right?
Exactly.
So I think we're just back in the trading range on the 10-year, which is too bad. And then our bond signal had switched. I don't know if it'll switch back or not. We got a sell here from our buy back on 135. Again, you might get a little whip. You might get a little whipsaw here. I don't know. We'll see if it goes back, but we'll have to see. Right now, until it crosses, though, the trend following signal is for lower prices on the TLT. But again, that could switch pretty quick.
Right.
We might have one of these in here. So we'll
Yeah, a
have
little
to
bit of
see.
whipsaw could, yeah, kind of looks like maybe we are gonna just kind of chop here. So we'll see.
Yeah, and then we had somebody wanted to see the gold miners. So now that we're back on Streets Burned Edge, we'll take a look at that. And obviously weaker than gold because it's in some of the indices, right?
Right.
But you know, we had a rally back to the neckline of the Head and Shoulders, and then yesterday we bopped right through there, which kind of negated that signal, and now we're testing it again. So we're kind of at a key level here. Obviously, if we take out this low, now you're making lower highs and lower lows. And actually, you are a little bit anyway. So couldn't get back through the 20 even on yesterday, which is the orange line, even on yesterday's strength. So again, like we've been saying, the easy money on these mining stocks might be over with on the long side. We wanted to look at the silver, and I'll put up the ETF. That's what the question was, but I'm going to let you comment on silver.
Sure.
You know more about it than I do. Oops.
Yeah, just kind of a choppy
Yeah.
trade here. But overall, the trend is still up. So but yeah, I think kind of like we've seen in the gold market, I think we're just in this kind of sideways pattern here that Lee has very nicely drawn on the chart there. So I think, yeah, that's the range that you kind of look at. We're almost smack dab in the middle of it. So kind of similar to gold. It seems like a trading range right now. And, you got to kind of, I'd say, wait for the breakouts there if you want to, really kind of look for any kind of momentum in the market.
Yeah. All right. Let's look at the market. Well, I mean, obviously we pulled back. What I wanted to do though is when we have these big gaps down and weakness, I just wanted to go over if you think we're going to rally in the afternoon, you may not want to think that way. Let me go over this. So I looked at data from 1985, or I should say I saw data. Somebody else pulled this for me. 1985. Let's look at what happens when the market is down at least 2% at noontime Eastern. You'd have to say that is today, right?
Yes, it is.
Okay. And then what this research did was say, all right, before this happened was the market generally overbought. In other words, RSI was pretty high, oversold, or neutral. Number one, just before we go to the exact numbers, it didn't really matter. No matter what you were coming into the day, we gapped down 2%, and we're down more 2% at noontime. In all three cases, you kept going down the rest of the day and ended weak. So, and that is a total of, let's see, 51, about 130 cases of this. Pretty much all of them, you ended lower. Now, the only kind of good news is if you were overbought at the prior close, which we had been, the damage is not quite as bad as if you were oversold going into it, because the momentum was on the downside even prior. But let's just take a look at the average intraday performance. If you are down 2% at noon, at least, pretty much you closed at the lows of the day, those days, pretty much. So for what it's worth, this does not say that we're going to have an immediate buy the dip towards the end of the day. Now, it could be wrong, but I'm just saying, you look at data going back to 85, right? So you may not get the bounce that some people might be expecting.
Even today, during the morning, we really haven't had much of a intraday bounce at all. It has been pretty steady to the downside, and so even a few points. And this is probably the biggest bounce we've had really for most of the session. We're about 20 points off the lows here in the futures, at least. So it's
and could you just let's put up the futures, because it's kind of similar. Just to go over the curves that you had mentioned earlier.
Sure.
I'll put up the E-minis here, but it's basically the same on the market. But let me just put up the E-minis. And then, so we're down 4.19%, but we're still pretty far away from the first curve, aren't we?
Right. 7% is the first curve, and that comes in at 29.65 on the June futures.
Okay. So that's when they halt for what, 10, 15 minutes?
I'm not, it's 5 minutes, 15 minutes. It's a short halt, though.
Okay. Yeah. So anyway, that is a kind of something just to keep in the back of your mind as well. Let's go back to the S&P. What day is it on Thursday, Mike?
It's Sentiment Thursday, Lee.
That's right. All right, let's go over the sentiment. So number one, I did say yesterday that based on the behavior after the announcement that we are in a recession, that you had long-term good results, but choppiness and weakness over the next weeks to months. So I think that a couple months only though. So I guess what you'd have to say there is that is kind of coming to fruition right now. Also, the spread between smart money and dumb money is over the 25% threshold, but to be fair, it was over so smart money is at 76, dumb money is at 46, so a 30-point spread. But to be fair, we had that spread from about here up to there too. So it's, it is generally a little bit negative, but on the other hand, you can still go up with that. But anyway, that is just a little contrarian optimism. We also had a little bit of, so that is smart money, dumb money. The next one we look at is the newsletter writers. Now remember, this is as of over the weekend, though. It didn't count this week's action, but the bulls went up to like 59.6 or something like that. The bears dropped to 20.6. What I generally follow is the bull bear difference. It did go over 35. It's now 36.3. So that's a warning sign, but maybe this might be it. I don't know, but certainly it was getting a little frothy there. The only thing that was kind of interesting to me is we've been talking, Mike, about the, Ma and Pa investors with the American Association of Individual Investors,
Right.
they never have gotten bullish since the bottom, and they are still not bullish, which is kind of odd to me because, we said also on, I think it was Monday or Tuesday, when I gave everybody that option data where there was just so much speculative buying and more of it was on the call side, that it was getting a little frothy, but the AAII data doesn't necessarily support that. But
Maybe it wasn't Ma and Pa. Maybe it was son and daughter there.
yeah,
A little more optimistic than
yeah,
than the folks there. So
yeah. But anyway, just to so the AAI survey never really did get to extreme bullishness. As a matter of fact, they're still at 38% bears, which is over 30. Their historical average of 30, and the bulls are at 34.3%. Their historical average is 38. So they never did buy this rally.
makes me
All
wonder
right.
though if they're just waiting for a pullback like this, or maybe a little more, and see if you do find that buying finally come in, or yeah, that'd be interesting to see. Yeah, I think, like you said, they didn't get overly bullish. Are they really waiting for that dip? Like everybody kept talking about that, you need to
Right.
retest the lows as well too. So it'll be interesting to see if we get a,
A
even
little
a
bounce.
10% correction, right? If we start to see some of that buying come in.
Yeah. So I didn't. We have a question. What happens after one of these really bad days? I didn't look that up. We'll probably look that up tonight. All I can say is that the rest of the day. So what I did say was the rest of the day will probably not get a huge rebound into the close. Is the best you can say from what I've seen so far. Now, if you are kind of gutsy, you do have a pullback to a widely followed moving average, the 20-day. You could make a stab at it with a very tight stop, because really we're still making higher highs and higher lows, but
Right.
you know,
In fact, we're probably really just testing that trend line. If you draw that from those
yeah, let me do that.
those March lows, we're probably right there.
Yeah, there you go. So, I mean, it wouldn't be the worst idea if you think this is overdone. I mean, you could really good risk to reward. But our data that I just went over shows maybe if you want to do that, maybe you wait because it could be a little weaker in the afternoon. Then you'd have to say, well, are we actually failing at the 20-day? So it'd be very interesting to see how it behaves around there. All right, let us look at the NASDAQ. Well, it took out very minor support up here, holding up. It's holding up better, but the reason is the same. It's not necessarily good, okay? Because the reason this was holding up better, and we'll see it even more in the QQQs, is the renting of liquid stocks to have some exposure, the big mega cap names. And I don't think that's necessarily a positive. And let's just take a look. So, I mean, we pulled back to a interesting level on the Qs, though.
Right at those.
You get the
the
10-day
previous
moving
high.
average and the previous high. So you could pay your money and take your chances there. So we've got a question, the 5-day EMA crossing the 13-day EMA. The last time was February 21st. Well, some people follow those. I don't follow those particularly. People use the 5, 13, and actually the 8 as well, because they're Fibonacci numbers.
Mm-hmm.
But I would say they're less widely followed than the 20 and the 50 and the 10. But if you want to do an analog, you are right. They have crossed, and that was it wasn't a great development, as you noticed back in February. We have a question. Do we have a 4-day island on the SPY? Let's take a look. I would say that is.
Yes.
Yep. So that could be an island top, at least in the short term. So Rick from California, what that means is that was a short-term reversal signal when we started filling the gap, but we've filled it even before we opened.
Right.
So I think that was certainly a negative sign. And I told everybody to get a little bit more defensive at the beginning of the week based on that option data. So the question is, let us see if you want to take a shot on the long side again, let's also look at retracement support. So we've got the 20-day moving average as a potential place it could stop. If that breaks, then you're looking, let's put the 50 on here. So the next level of possible support, if this breaks, would be 29.50 on the S&P or 295 on the spiders. Now let's see if there's any concurrent retracement areas here. So let's put up the Fibonacci's. Oh, I don't want to do orange. Everything else is orange. So we'll put up blue here. I guess you can't see that either. Yeah. I'm a little colorblind, so it's, yeah, let's do that. Okay.
There we go. Nice pastel colors.
Yeah. Well, you got Fibonacci support at the 23.6, which is pretty close to this little double top we had there before. So 290, again, 295, 29.50. That seems to be kind of the area to take a look at, I think. So take that off. All right. Let's see. What are the support levels for the SPY? We just did that one. The 20-day is the first support, but then you're down there at 295. And then on the Qs, you wanted the support level. Well, we're right at 238-ish on the Qs. That's pretty major support, actually. If that breaks, you're going to test the 20 for sure.
Right. So around, yeah, by 232, maybe 233.
Yeah. Okay. Question on the VIX. This is very reminiscent, and I pointed this out too. I'm going to go to my my stock charts chart. We had talked about this like 2 weeks ago, and now we're going to take a look at it again. So we never did break support on the VIX, which would have been more of an all clear signal. This is looking very similar. I'm going to, of this, where I have this red line. So what I'm going to do is I'm going to move that. Let me just take it off for a second. Okay, it was the same thing that happened right here. We tested support and then we held it. So we couldn't get below it the last time. And we have kind of the same thing here. We tested that support level and again, couldn't get down through it. So to get the all clear for a longer term, you'd like to see the VIX break that 23, 24 level. But that's a key level if you're looking at the VIX right in there. And now, as far as our Bollinger Band VIX signal, let's take a look at that. Again, this is a longer-term trend following signal. And what we would be looking for here, get rid of this chart, is a turn up. So if the VIX goes up faster the next couple days, if this turns up, that would be a red line signal on the upper Bollinger Band. I've got all the signals for the last few years. You see they're pretty good. So we're also watching that. So on the VIX, we're going to watch this upper Bollinger Band to see if it turns back, which would suggest more weakness, or maybe the market's just getting it out of its system right now. Randy Frederick said a 5 to 10% correction. Well, he got his 5% today. We'll have to see if it gets any worse, but we showed you the levels. If it can hold those levels, this might be it. If they break, then maybe you're going down further. We just want to watch, see if this curls back up. That would be negative. But obviously, it'll take more than one day with a spike in the VIX to turn that around.
Right.
All right, now let's just look at what's going on with sector action. See if anything is holding up. So nothing is positive. Nothing is positive.
Yeah, it's that kind of day. I mean, usually you see something.
Yeah, nothing
there, but nothing.
Nothing. So let's just see what is really getting hammered.
Oil services.
Oil services, the airlines. So all the things that had a pretty good rally are giving it back a little bit. So even the home builders. So you can see what is holding up best. Video gaming, cancer research companies. So biotech is still showing relative strength, right? So let's take a look at some of those. They were testing support earlier. Let's see. Yeah, I mean they're down less than the market. I mean, this has been a pretty strong group. I think you still have to give the benefit to the bulls unless we take out that 99-ish level. Let's take a look at the IBB. So it broke out of the triangle, but we said this earlier on Trader Talk too. You got support right there too. So I think that's kind of key right there. Again, not down as much as the other areas of the market, but there is relative strength in this group. We got a question. Can you explain the high-low signal? Yeah, we can do that. Let me go get that. So you can add the high-low signal just by going here to columns and settings. Okay, and then the high-low signal is right in there. Where is it? Where is it, Mike?
I can barely see it myself here.
Yeah. Oh, there it is. There it is, right there. Right there. Yeah, under extended close. Okay, so the way you read this is as follows. Okay, the first thing is you have the middle line. The middle line is the opening price. So anything to the left of the line is showing weakness from the open. Okay, then the different colors. Okay, if it's a daily low, it's going to be pink. So this is down, but it's not quite a daily low, where this one here is a daily low. You see how it's pink? Pink, all right? Now you can customize those colors. If the entire cell turns color, then that would be a 52-week higher low, right? So looks like the mortgage REITs are the only thing that's up from the open. Looks like they're still down, but they are actually up from their gap. So it does just tell you what to look for really quickly, above or below the open. And then the colors that you pick, you do here. And okay, so if it is a 52-week high, you'll see the entire, the way I have it set up, the entire cell would be that light green. Okay, if it is a 52-week low, the entire cell, okay, would be pink. So there you go. And again, you can customize that. All right, we want to look at the semiconductors? Yeah. Okay. So it took out the 10 for the first time in a long time, the 10-day moving average. I've got this in here, though. I think this is the true support area. I'll just extend it. So I think that's a key level right there. 250 on the bottom of that area. All right, let's take a look at the home builders. They had been on a tear. So what they've done is now they went back into their channel, but right now they're holding the 20-day moving average. So if you think that this is it for the correction, if that's your view, look at the 20-day moving average on many of these things, because we have seen a lot of these declines hang around there right now, and we haven't broken them. But again, probably we're going to have a little bit more weakness this afternoon, I would think, based on that data I gave you. Okay, let's look at Staples to see. There's big, they had big downgrades on some of the staple stocks today.
Yeah, took out the 20 and now it's testing the 50.
Yeah, I don't know why exactly, but looks like the 50-day is something you might have watched there. Notice how all the pullbacks did stop at the 50. And so that's kind of the area to look there, I think. All right, with that, Mike, our time is up. It goes so fast.
It always does, Lee. And you have a good weekend and talk to everybody next week.
All righty. Coming up next year on Schwab Live Daily, Schwab Equity Ratings Explained. Want to know how we come up with our A through F